What's up, guys? We're going to be going an option strategy to make hundreds of dollars on the NASDAQ. So what we have right here is ticker symbol tqqq, and it's basically the NASDAQ, but triple leveraged. Now, these leveraged ETFs are kind of risky, but it can amplify your returns. And because it's triple leveraged, these ETFs are going to be a little more volatile than the traditional QQQ. But there's opportunities to make money, and right now is a very good time to make money with options because of the volatility. So we're going to be going ahead and taking a look at the chart. It's down roughly 50% from its all-time highs of around $90. So it's at a pretty good price point. And as we can see in the past 5 years, this ETF has done really well. However, these ETFs do pretty bad when the market crashes, as we can see in the COVID pandemic back in early February and March. It took a huge nosedive. So that's the dangers of these leverage ETFs. But eventually they recover, and as we can see, past 5 years, it's up 633% despite this huge drop. So it's pretty good stuff. So let's head over to the options chain and let's show you guys how to make money. So we're going to be going over to the March 11th expiration, which is roughly a week and a half from now. And we're going to be going down the strike prices to the $45 strike put. And we're going to be doing a sell put. This is going to be a cash cured put. Selling puts on triple leverage ETFs is probably one of the safer ways to play these ETFs rather than just buying outright call or put options. So selling options is going to allow you to capitalize on the higher premium that's associated with these triple leverage ETFs. So we can sell some of these puts, and let's say you have a $20,000 account. We can sell 4 of these contracts, which is going to yield us $708 for a week and a half, putting down a collateral of only $18,000. If you have a smaller account, if you only have 10,000, you can sell 2 of these contracts. You're going to be making $354, and that's a pretty good return despite it being only a week and a half out. Patience is the name of the game here. We want the premium to bleed out, and it's a win-win situation. You either own 100 shares of the stock, or the contracts expire worthless, and you collect the premium in full. Once you sell these puts, the credit goes directly to your buying power. You can immediately withdraw it and do whatever you want. Pay bills or take yourself out to a nice restaurant, which is pretty sweet. This is literally passive income. You just sell these contracts and then wait till expiration to do your next move. If you get a sign on these shares, all you have to do is go ahead and turn it around by selling some covered calls, which is simply the wheel strategy. It's a very proven strategy, my favorite strategy, and I've grown my account to 6 figures using this strategy myself. So what we're going to be doing is the 45 strike looks pretty good, and as we can see here, it has a 73% chance of profit, which is pretty good odds that we're going to be making money on these contracts, especially since right now is a good time when implied volatility is high. As we can see, it's 123%, which is quite above average for this ETF. But if you want to take a look at the top holdings of this ETF, we can see that it's mainly in the technology sector, and we have solid companies. So owning this ETF, especially for the short term, is not bad because you're getting some really great companies inside of this ETF, such as Apple, Microsoft, Amazon, Facebook, known as Meta, Tesla, Google, Nvidia, Adobe, Broadcom. So we have these huge name companies into this ETF. So if you do end up getting assigned 100 shares of this ETF from your cash cleared puts, it's not a big deal, and you can always go ahead and sell some covered calls above your strike prices and make that nice weekly income. So that's about it for this video. Thanks for watching.